Well, tonight we have a very, I think, really a terrific topics, and I'm quite excited about it. The first thing I'd like to do is I'd like to just say what my process is and how this kind of all fits together. And I think almost everybody here knows this process, but we look at the macro picture, the economic situation, and we see where there's risks and opportunities, and we try to invest into the best areas. Then we have to figure out how we're going to buy our stocks and bonds into there, and we found that there are 20,000 mutual funds out there, and really, it's the 80-20 rule was always there. There's 20% that are really quite excellent, and 80% are below or average. But 20% of 20,000 is still 4,000. So there's really a lot to pick from. And so we can cherry pick the very best ones. And so tonight, I want to show you what we got, and I'm really quite proud of it. And that's how Brendan comes in, because he's the managing director of one of the funds that we're using. And he'll talk in more detail how they pick the stocks and bonds and what their process is. What we then do is, after we decide where we want to be and then we pick our funds, then we build models. And so we have a model that has all stocks in it, funds that buy stocks, and we have, at the other extreme, ones that just buy bonds just for income. And then we have some in between. So after interviewing each person, we decide what's the best risk tolerance for them, how much stocks, how much bonds would be for each individual client. Maybe each individual account. And then, as you know, during the year, we review with everyone their financial situation, see if it's changed, and see if we need to make any changes to the portfolio, and then we rebalance and invest. So tonight, we're going to look at the economic situation, and we're going to look at the stocks, the funds that we buy. So, if we just have just a slight look back at last year, what really happened, and I'm going to talk about the performance of last year. It was at the beginning of the year, and really through about to the middle, there was really a lot of consternation about Europe. And Europe really got in the big debt crisis, and got overextended, and they have gone into a recession, and are still there. Our economists predict that they'll come out of that this year. So, and incidentally, we haven't been in Europe now for a couple of years. We were, luckily enough, predicted that wasn't a good place, and so we have avoided that downturn. Last year, the U.S. economy grew by around 2%, and the stock market grew in double digits. The Dow grew around 11.2 or 3%, and the S&P 500, which was particularly affected by Apple, which grew a lot, and it's the biggest holding into there. It grew almost 15%. And the NASDAQ grew around 14%. So the Chinese economy had been running at a growth rate of around 10 to 12%, and last year was a 6.3. We exited China around a year and a half ago, and avoided some of the downturn, but it's recovered a fair bit, and BCA is predicting that it's going to go back to around the 8% range for this year. The Federal Reserve has really been trying to help the economy tremendously, and as you know from the news, it's kept interest rates very low, and if you've got a savings account, you know, like it's like 0. Or a CD, it's like less than 0.5%. So the Federal Reserve have left interest rates low, and then have been buying up mortgage-backed securities and other things to keep mortgage rates very low and try to get that going. And so that actually was good for the housing market, and it started to rebound. The fiscal cliff was avoided, maybe kicked down the road a little bit. But at least we didn't have a big fiasco from that. Congress did finally agree to do something. And stocks remain at low values versus historical terms. So I got a chart in a minute that will show you that stocks are around 12.5 times forecasted earnings. Typically they're 16. So all the worry that's out there is kept stock prices somewhat low. So that was last year. So what is the outlook for this year? This is
2001.
doesn't seem to want to do that, Mike. Oh, there it is. How's that? Okay. We use BCA, that's Bank Credit Analyst, and we found them to be a very good independent economist. We do receive economic information from a variety of sources, but we found that the BCA is the most unbiased. Not always right, but the most unbiased. When we hear Brendan talk a little bit later, he's going to talk about the economy and what they do too. And so it'll be interesting to see how it all comes together, but I think it'll be somewhat close. BCA believes that 2013 will have more optimism into it, and so that will be good for growth. They think Euro area should exit the recession in 2013, and China will grow at around 8%. The U.S. growth rate should reach 3% in the second half, but the first half wouldn't be so good. U.S. politicians are not likely to reform taxes and entitlements enough. That's BCA's opinion. I received a fairly lengthy analysis from them today, and it was their opinion that we really need to reform our spending and or our budget position, because we're at around 85% of GDP in our deficit position, and that's really too high, and that's around the same as Spain. And what happened with Spain was people said, gee, I don't really want to loan you any more money. Your deficit is too high, and your likelihood of getting it down isn't so good, so I don't want to lend you any more money. And so they said, well, lend us some more money, and then they said, well, at this rate, this high rate. And so the European Union had to come in and bail them out. And so that's, we're not at that tipping point because we're the strongest economy in the world, but we're headed there. So something has to be done in that regard, and Congress has got to get together and figure that out. And but it's a painful thing. And as you know from what's happening in Europe, it's been a very painful thing for them to do, and it will be for us. And so we can either smooth it out or do it all at one time or some combination thereof, and that's what Congress has to work out. But BCA doesn't believe that this is going to affect us immediately. We've got time on our side to get that going, but it is a necessary thing that we have to do. Minimal inflation is expected in 2013 by BCA. And investors will continually search for yield. With interest rates being so low and the Federal Reserve and treasuries, it's pushing all the yields down, and so everybody is searching for higher yield someplace, taking on more risk. So we'll talk about that a little bit more, what we're doing in that regard. They think that global equities will rise around 6%. When we look a little bit later on in my chart of the Dow, you can see that it's going to grow. The earnings are projected to grow around 6.3%, so it kind of falls in line. So if everything was normal, you'd expect around 6% return. If you stay at the same ratio as now, a growth in earnings of 6% would translate into a growth of stock of 6%. BCA favors energy, technology, healthcare, and banks. And they feel that with the growing economy, commodities are going to be more in demand and should press the prices of those commodities higher. The U.S. Currency is expected to lose some ground next year. And the Middle East, which is a pretty volatile area, particularly with Iran and Israel, shouting at each other and perhaps headed towards war. They just don't think that's going to happen. That's their prediction. I was with not a lobbyist, but a consultant from Washington, and that was the case that they thought too, that there'll be a lot of arguing and shouting going back between Iran and Israel, but they don't really want to have all that bloodshed because it would be very messy on all sides and a lot of deaths. Now, this is in your book, and so you don't have to look at all the details of this one. I just wanted to give you the highlights. What I got here is, these are all the companies of the Dow. There's 30 companies in the Dow Jones Industrial Average. And this is the price of one share. And the earnings of one share. And so the price to the earnings ratio is a very important ratio, because as the earnings go up, so does the price usually. Maybe not exactly in correlation, but over some time, that's how it goes. So the price to earnings ratio right now is 13.17 of all of these. And as I said, typically it's 16. So if things were normal and there wasn't so much worry out there, we would have a Dow of 17,000. And now we have 13 and a half. I had a text from Mike who wanted to know how I managed that the stock market kept on going up just before my meeting. It's a very powerful thing that I have. And so if we looked at the earnings projection for next year, and we took the ratio is only 12.39. So it really says, versus normal times, stocks are pretty cheap. And the reason why is that there's a lot of worry about it's risky up there. So if we could get rid of some of that risk and things start to go, we have a lot of upside in the stocks. And so really, if it was traditional, it would be a Dow of 18.5 versus, say, 13.5. So that's almost a 40% increase. So if things start to pick up, we have a lot of room in the stock market to grow. So I think that's really a perfect position to be in. This is like buying low, and hopefully some good things will happen, and we can sell high. So I see this as a very good thing. Now here's an interesting thing. Here are all of the companies of the Dow, and the dividend rate is 2.64%. You know, CDs are at 3/4 or half or something like that. So these really terrific companies, 6.4 is a dividend rate. So if the stock didn't go up a bit, you're going to get 2.6%. So we got a stock market that's pretty low in price versus normal times, and a very good dividend. This is a really good time to be an investor. I'm actually pretty excited about this. Some people get excited about other things, but this excites me. So how did we do last year? Well, in our growth model, which is all mutual funds of all stocks, we were up 15.17%. The balance for the growth model, which is 70 to 80% stocks and 20 to 30% bonds, is up 12.67. The balance model, which is roughly half stocks and half bonds, 12.45. Income with moderate growth, 8.8. And then if you have all fixed income, all bonds, it was up 7.4%. So these are results from actual accounts, and as after fees. So this is our result. This is what you see in your portfolio. Now, every one in those models isn't exactly the same because some people take money out and we rebalance at different times. So there's some slight variances, but those are reasonably close to most models.
And are they in the book somewhere?
They are. And this is in the book. And then I have in the book each model. And here is the balance with growth model. And so what I wanted to show you in the balance with growth model is like how we pick each one of those. And one of them is Marketfield, which is what Brendan represents. And so we selected all these, and I'm going to tell you why we selected them, and then I'm going to let Brendan talk about his particular one. But I wanted to talk just about the changes that we're recommending for this year and that we intend to put in the portfolio. So last year we had Marketfield Flexible Income, and it was great fun. Large cap, large companies, they made 23% last year. It was really a perfect one of our best funds. And then the portfolio manager left just towards the end of the year. And the two sub-portfolio managers, one guy runs an emerging market fund, and it hasn't been that successful, and the other guy has never been a portfolio manager before. So I really hated to get out of this really terrific performing fund, but the management, I couldn't rely on it, so we went to look for a replacement for that. And the replacement was FMI. Where is that? Put that? We replaced it with FMI. Somehow we didn't put that up on there. We took out one of the large cap funds that we had that performed quite well, not as well as Marketfield. It was around 14 or 15%. And we decided this year we wanted to go after some funds that were funds that picked stocks that really were growing. And we felt could outperform the market. Mainstay, Marketfield was one of the ones that we did last year, and we continue to have them, and we wanted to add some more like them. We had a First Eagle High Yield Fund, which performed very nicely last year, and but this year we think that the bond market is not going to perform nearly as well as it did before. So we wanted to get rid of that and get one of these stock funds that went after high growth companies. And PIMCO Bond Fund is a corporate bond fund. We already had one PIMCO Total Return Fund, and we decided that we would like to replace that with a different fund just to diversify ourselves. It performed very nicely, but we decided we wanted to change it. So as well as adding the FMI, which was replacing Marketfield, this year we're adding Vertus Global Real Estate Fund. That was up around 23% last year because the real estate market started to take off, and we think that there's lots of legs left in that. And we talked to these fund managers, and we talked to them right after they had their annual meeting, and their growth projection is pretty similar again for this year. We're adding Wasatch World Innovators Funds. So this is a fund that tries to pick fast-growing companies. And I happen to have dealt with this fund for quite a long time. You've seen it in our portfolios in the small cap. And so the owner of the fund, or the main owner, his name was Stewart. He became chairman and wasn't running the fund anymore, and his son wanted to run the fund. His son had been a portfolio manager for a while, and his son says, "I like to go after innovative companies around the world." And so the father said, well, that's a good idea, I think I'll go with you. And so they have formed this fund together. They're the managers, they have other research people. But I thought this was the perfect thing. The young buck who wants to find all the very fast-growing companies, and the wise father who's been in the business for a long time and say, well, maybe we should take that one, you know. And so I thought this would really be a terrifically well-managed fund to go after high-growth companies. Franklin Templeton Utilities Fund. So we've been worried about bonds decreasing in value. If interest rates start to creep up, we're not forecasted to do that for a while, but if interest rates start to creep up, then the bond values will go down in value. So we replaced one of our bond funds with a utility fund. And so I'll tell you a little bit more about that utility fund in a minute, but very good yield. With housing starting to pick up, utilities should do fairly well. So there's some good growth in utilities. It's a regulated business, so not too much growth, but there's some growth into it, plus a nice return. And I think it will outperform treasuries and really conservative bonds. And then we have the William Blair Bond Fund, which is a corporate bond fund by corporate bonds and mortgage-backed bonds. And mortgage-backed bonds means that they're bonds and mortgages, and that's what the Federal Reserve are buying up. So there's a lot of demand for that. So I thought that was a pretty good, safer bond area to be in for a while. So that's why we selected that. So I'm just going to go through these funds again in a little bit more detail of why we selected them, and then I'd like Brendan to talk to us. So FMI, as I said, large companies, and these guys have been in the business for 30 years and really a solid track record. 5-star rating by Morningstar and a gold rating, which is the highest return for the risk. And they're basically looking for a strong financial company, financially strong companies that should continue to hold up in this low growth environment. And so we thought that was a very solid one. They returned 14.86% last year, so pretty solid. BlackRock is a fund that we've had and we're continuing on, and once again, it's got a lot of companies that pay very nice dividends. So we thought in the slow growth time, boy, we want companies that are paying dividends. If it grows 6%, like we said, and they pay dividends, there's like 8.5. So that seemed like a pretty good idea. It's 4 stars by Morningstar and rated silver. First Eagle Global, and this is a fund that we've had for quite a long time. Very conservative, solid fund. 5-star rating by Morningstar Silver. By large, globally well-run companies. It has actually a significant holdings in gold. About 5.6% of its portfolio is gold. But a very solid, well-run company. Analyze companies from the very bottom, compare their management, their products and services versus others. It's really a bottoms-up type of approach. Mainstay, Marketfield, Brendan's company. They have, Brendan will get into it in a little bit more detail, but they have a theme of looking at the macro picture, much like us, and then trying to see the investment opportunities, where they should want to be, and then they go after companies, and they have a bottoms-up look at all companies into the areas that they want to be in. Morningstar 5-star rating, bronze. Return of 13.5% last year. Putnam Equity Spectrum Fund. This was a fund that we picked last year that we're continuing with, that is very good at picking stocks that really grow. And what their particular technique is, they look for companies that got quite a bit of debt. And as you know, if you have a certain amount of debt and you can pay very low interest rates, and then you can make a fairly good return, you can really leverage your money and you can really make a lot of money doing that. Thing is, some companies have a lot of debt because they're not that good. And so these guys are particularly excellent at finding companies that are leveraged but are solid. So I'll tell you how I discovered this one. I went to visit Putnam in Boston, and I was looking at various funds, and I was particularly worried about interest rates going up, and I was looking for bond funds that would stay solid if interest rates went up. And just by chance, I went in to see the fund manager on the equity spectrum fund. And I found that a bunch of the managers managing the other funds were putting their money over with him. So I thought, this is pretty interesting. And then I found out that he had been a former hedge fund manager, and that he left the hedge fund because his son was quite sick. And then his son recovered, but he still wanted to spend time with him, but he didn't want all the worry of running a hedge fund. And so Putnam offered this job to run one of their funds, and they would supply a lot of management and service and that sort of thing. And so they were pretty lucky to get this talented guy, and I think we're lucky to be in on it. It made 24.29% last year, so excellent. Morningstar 5-star rating. It didn't have a rating of gold and silver and that sort of thing, but it's somewhat new. Wasatch Small Cap this is the fund that we've been in for quite a while. This fund manager was nominated as Fund Manager of the Year a couple times in a row. He's very well regarded. 5-star Morningstar rating, gold. Made 16.95% last year. So they buy smaller companies. So in smaller companies, there's much better chance for growth, but smaller companies have more risk. And so Wasatch is very good at analyzing these companies for risk and for return, and they really do a detailed bottoms-up job of really looking at the company as if they were going to buy the whole company. So it's really a fine mutual fund. Burgess Global Real Estate. So when we looked at the economy, we said, gee, this is a growing area. I think we should be here. And there's several of these real estate funds. The advantage, some people buy REITs. And if you buy a real estate investment trust, the problem is you can't get your money out. It's kind of locked in. You might be able to get a little bit out, but you're really kind of fixed into it. And so they make a very nice return and all, but you can't get your money out. Well, if you get a mutual fund of real estate, it operates virtually the same, except that it's liquid, and you can sell any day if you wanted to. So if you need money, you can get it out. So this seems like a pretty good idea. One advantage of a REIT is they actually pay like fairly significant dividends. This one doesn't pay so significant a dividend, but it's completely liquid. Morningstar rated at 4 stars, and last year it had a 23.4% return. And this Innovators Fund, I just told you about that one already. So in the bond funds, so this is definitely really important for our investors. We want to have a solid part, not too much risk, giving a nice return for people that are in retirement. They need to have a certain part of their portfolio that's quite secure and but gives a return better than CDs. So if we were to buy treasuries, it's a little better than CDs, but it's not too great. And treasuries are overbought and probably will go down in value. So we don't want to be in treasuries. So we found that corporate bonds were kind of the best. The interest yield on those was around 3.5% to 4% for solid companies. And we had some nice capital growth this year, so we think think that's still a good area. I don't think there's going to be capital growth into it, but it still gives a better return than we can get in treasuries and CDs and government protected things. So, so this PIMCO fund is actually, total return fund, is the largest fund in the world. It has the most money into it of any fund. And the portfolio manager's name is Phil Gross, and he's like when they invested the TARP money, he was their advisor of how to invest the TARP money. So he's like famous, he's always on CNBC and those programs, Bloomberg, like Brendan. Maybe he's on a little more than Brendan. But anyhow, a terrific fund. And so they do another thing. So they take on a little bit more risk to get more return, and they buy a derivative, which is sort of like an insurance policy to protect the downside. Now, this is a tricky thing. It costs money to buy an insurance policy, and some people in the derivatives, they get selling the derivatives, they try to make money in the derivatives, and it gets really complicated, and you really have to watch it. So I'm always like leery of that, but these guys are the best at it. So and they seem to do it in a fairly conservative manner, and their returns over the long run are really good. So last year on this bond fund, it made 10.04%. So pretty excellent. The yield on the actual interest rate, like the coupons on the bonds, is 3.8%. Metropolitan West Total Return Fund is almost the same kind of fund, just a different manager, some different bonds, but similar. And their return last year was 11.39%. So quite excellent. And they use agency-backed bonds, like I was saying, that William Blair did. And they're noted for their extensive research. And they're very good at buying bonds low priced and selling them high. So there's definitely an art in bond trading as well as stock trading. It's a little bit more conservative, but you really have to analyze the company very, very thoroughly. Brendan did that in one of his careers. Franklin Utilities Fund. Once again, this is the conservative part of the portfolio. We wanted something that was going to give a better return than CDs, but yet wasn't too risky. This is utility funds are regulated. This Franklin Fund only buys that. There are some other utility funds that actually give a little better return, but they buy oil and gas and energy companies, and it's much more risky. So I wanted one that bought and sold and owned regulated utilities. The yield on there is 3.62%. So if you didn't have any growth, you'd still get 3.62%. 5-star rating by Morningstar and gold. The return last year was 5.85%. And William Blair Fund, our last conservative one, focuses on corporate bonds and mortgage-backed bonds, and the only treasuries they have on there are TIPS, which means Treasury Inflation Protected Securities. And so if inflation goes up, so does the return on those. So that's a small part of their portfolio, but if inflation starts to pick up, that's a good thing to be into. Not projected any inflation for a while, we saw in BCA, but it's coming. And they're definitely focused on beating the U.S. aggregate bond index, and it's a 5-star rating by Morningstar, and made a 8.35% return last year. So you can see that we put a lot of thought into the funds that we pick, because they buy the stocks and bonds that are in your portfolio. So it takes a tremendous effort to do all the research and the digging and then the executing of buying the stocks and bonds. And so at Locke Financial, we realized quite a while ago that, well, there's a wealth of really intelligent people out there. And we can get these people, essentially contract them for a really low price because it's spread around a whole lot of people. The fund is owned by thousands of people. And so we really get a bargain. We get really smart guys like my speaker coming up here. And so I feel really fortunate to be able to bring Brendan Moynihan here tonight. So he has a bio, and you saw it in the invitation, and it's been reviewed by compliance. And it's quite excellent. But I met with Brendan, and I've got like a few insights that I wanted to share with you. First of all, he was born in New York, but raised in Alabama. So that makes him a good old boy. Graduated from University of Alabama in 2.5 years. So he told me, he said, I really wanted to be a trader, but I thought I needed a degree, and I thought I should just get right at that. So he just like went year-round and did it for 2.5 years. It's kind of got a strong work ethic. He spent his formative years as a bond trader and a currency trader, and did a pretty good job because he retired. And then he went home and he helped raise his sons. And he stayed home for 10 years, and now he lives in Barrington Hills, and so I think he's like maybe doing okay. And so that's the kind of guy we want working for us. It was a success. And so he got a little bored with all of that, and he decided he wanted to go back to work, and so Vanderbilt University wanted him to teach a course, and Bloomberg wanted them to write a special program from them, and after they saw how good it was, then he got to be training the Bloomberg people how to do it, and so he's a well-regarded person. And so Sai, you'll like appreciate this. So I said to him, so you're in Chicago here, so who do you cheer for, the Cubs or the Sox? And he said, well, really, he says, I got Bloomberg hooked up to my laptop, to my office computer, and I really don't have time for sports. I said, well, that's a good answer, but that's the kind of guy we want. I would have liked the White Sox answer, but that was really better. So without any further ado, I'd like to introduce Brendan.
Good evening, and thank you for taking time out of your schedule to come in tonight and listen for a bit. What I thought I'd do is just tell you a little bit about how we go about doing what we do, and then give you a little bit of perspective of how we see the economy and the markets unfolding here over the course of the next several months and into the balance of the year. Basically, we take a very macro view of the world. We have the ability to invest anywhere in the world, and we do. We have the ability to go both long and short, and we do. We look as far afield as Switzerland, Brazil, Japan, and as close to home as Cupertino, California. Does anybody see the news here late this afternoon with Apple?
Yes.
Apple's trading at $459 a share after earnings. Yeah. And I'll tell you a little bit about Apple as we start to kind of go through this a little bit. But we try to take a very global macro view and then identify places where we think things are, run reasonably well, a country being run reasonably well, like a company being run. And then we do bottom-up research to develop themes for where we want to deploy capital, and then find companies that fit that theme. Now, within the theme, for example, housing. In 2009, we believed that the market had, one, gone too far, two, discounted complete disaster, and was ignoring the fact that every recession since World War II had been led by the housing sector, construction in the housing sector. And one of our themes was the housing market starting to clear, that things were starting to stabilize, and we invested in the housing sector. Now, ordinarily we think about and buy housing stocks, and that's only one of the things we did. What we try to do within the theme is then diversify the securities across the spectrum so that we're not just concentrated in that one idea within that theme. So the recovery of the housing market is something that we put on the books in late 2009. It's a theme that we still have operating. But we did the likes of buying some home builders, but we also bought Sherwin-Williams, we also bought Home Depot, because they're companies that are going to benefit from the development of that idea, assuming that we're right, without having a heavy concentration just in that one sector of home builders in that arena. So we try to do the same thing across different themes that we develop. We'll have as many as 6 or 8 themes within the portfolio, and then within there, we'll have anywhere from 10 to 15 stocks. We might be running a portfolio of about 90 securities in total. But within each of those themes, we tend to be diversified so that we're not just so heavily concentrated and exposed in that one arena. So that's how we go about doing what we do from the big picture now. Where we are now and the way we see things unfolding is we sort of divided the world into 3 broad categories. We think the U.S. is doing quite well. We think that emerging markets are doing worse than people are giving them credit for. And we think that Europe is doing better than people are giving them credit for. We've now moved the portfolio over the course of the past 6 to 8 weeks to about 24-25% in Europe. We started about a year ago, mostly in Northern Europe and the core countries that were doing better than the periphery. And over the course of the past several weeks, we've moved more into the periphery. Italy is one of the places where we deploy capital. Italy outperformed the Dow last year as things turned out. Italy is up 8% so far this year. And we think that's maybe got a little bit ahead of itself. We weren't necessarily predicting it's going to be that far that fast, but we're being rewarded for that insight into how things are starting to unfold in Europe. They had great influx of monetary policy starting about a year ago after Man Financial collapsed. Does everybody remember when John Corzine blew up the firm Man Financial at the end of 2010? Well, when that really started to unravel and hit the European financial markets is when the ECB really kind of stepped in early stages and started to implement a program of monetary ease. They really stepped in July 26th this past year, when the central bank president came out and said that they would do, quote unquote, whatever it takes to save the euro. So there's been a monumental move there finally, after several years of crisis, to try to address the problems. And the way we see things is that you now have the 3 major economic arenas in the world, Europe, the Eurozone, Japan, and the United States, all operating with very aggressive monetary policy. The Federal Reserve has been the most aggressive and the earliest in implementing it. But the Bank of Japan, over the course of the past 3.5 weeks or so, with the new administration coming in, has come under intense pressure to adopt a significant monetary easing. They've adopted an inflation target of 2%, which is something they didn't have before. The Japanese yen has dropped about 12 or 13% over the course of the past 2 or 3 months. The stock market has responded by rallying about 22, 23%. Some of the biggest gains, the longest stretch of gains since 1986 in the Japanese stock market, which, after 2 lost decades, things are really starting to finally kind of get some traction over there. So we think that finally you have the major central banks of the world sort of following on the heels of the U.S. Fed. And for lack of a better expression, we're calling it the Bernanke boom. That when the Fed in the United States first intervened to implement quantitative easing in late 2008 and early 2009, they did it when financial conditions were under tremendous stress here in the country. When they embarked on quantitative easing 2, QE2, you were still under a fairly significant amount of financial stress in the country. This last round of QE3, those stress indicators are actually in positive territory, the best they've been since 2007, and yet the Fed is still being very aggressive about how much it's putting into the economy. The Fed is buying $85 billion a month worth of mortgage-backed securities and treasury securities. The federal deficit this year will be about $1 trillion, and that's about what the Fed is going to buy over the course of the year. And the Fed's doing that at a time when things are starting to kind of hit on cylinders. So what it's done is it's developed a couple of things for us. We are, as I say, we think that the monetary policy is starting to get traction in Europe, so we're constructive in Europe. We think it's doing better than people are giving it credit for. We continue to believe in the housing sector here. We're 3 years into that theme, but we still think that there is room to run. In a normal market in housing in the United States, and by normal we would say from the year 2000 to say 2004, maybe 2005, before things really got out of control. the amount of money that the housing sector contributed to the U.S. economy versus where it is now, that discrepancy is about $1.2 trillion. The U.S. economy is only $14 trillion, so somewhere in the neighborhood of 10% under capacity is what the housing sector is running at right now. We're not even saying it necessarily has to fill in that entire gap of 1.2 trillion, but just getting back towards some sense of normalcy is going to provide tremendous impetus and kick to the U.S. economy. So we're still very constructive on that theme that we've had going for the past several years. We do think that emerging markets still face some significant headwinds. We think that the market's sort of bifurcated. There's, for lack of a better expression, there's good EM and bad EM. Some of the larger countries we think have some of the bigger problems, Brazil and India, China. We think that some of the smaller markets that have been attracting the capital here recently, Turkey and Thailand, have been on a particular tear as money has kind of flowed in there. But we're steering clear. We're not, well, we have nominal shorts in some of those markets, but it's not an investment theme that we're participating in on the long side and recommending. The other one that we're participating in is what we're calling the safe haven trade. We think that there have been a number of securities, Apple being one of them, gold, U.S. Treasuries, that have attracted capital over the course of the past 2 or 3 years because people saw those as safe places to be, that things could not or would not go bad in those environments. And these are markets that we have taken selective short positions in. We were short Apple from about $700 down to about $525. We no longer have the position, so I'm allowed to talk about it. This afternoon, the stock closed at $514. When I left the office, it was trading at $459. So, in addition to the 29% drop that it's had from its high going into the close today, it dropped 11% after the close. So, it's yet to see what's going to happen when we get in tomorrow morning and everybody has a chance to kind of sort it out. But the initial reaction is not so good. We think that within that, just to branch off for a second, is a technology theme that we developed in the spring, in the fall, that in the same way that we think there's good EM and bad EM, we sat down with technology and thought that there are some legacy technology companies that are going to suffer drastically in the post-PC environment as everybody moves to mobile and moves to tablets. So we built some proprietary indexes that we track that have equities such as Dell, IBM, Oracle, Apple, that we put into legacy technology companies. And then we found companies that we thought were going to benefit from this migration to mobile and tablets. And they're not necessarily technology with gadgets the way you would normally associate it. Rather, we look at them as companies that have unique business models that will have the ability to push content out to users. So companies like Amazon, eBay, Yahoo, that provide content. And over the course of the last 3.5 months, the divergence between those two sectors amounts to about 17 percentage points. That you've got the legacy companies that are down about 12%, and you've got the new technology companies up about 5% over the course of the time that we've embarked on this. Now, come back into the safe haven trade. Apple is one of those companies that we saw fit into that safe haven category. Gold, we believe, is the same thing. Gold topped 18 months ago. Over the course of the late November, early December, we saw record flows into gold ETFs. A record amount of money flows into gold exchange-traded funds. And yet, gold is still trading now below $1,700 an ounce, despite that influx of capital that's gone in there. So it's not what had been a very trending market, one-way market, stopped 18 months ago. We think people are still seeing it as safe haven, and we think that is divergent. And so we have nominal short in gold. Same thing with treasuries. We think that the amount of money that is piled into treasuries, just by way of example, over the past 3 years, you've had about $700 billion flow into bond funds, and you've had about $300 billion come out of equity funds. So you've got a lot of people that have abandoned the stock market and gone into the bond market and bond market funds in some way, shape, or form. Treasuries last year averaged, U.S. 10-year Treasury yielded 1.78% for the entire year. That's the lowest that we've had on record. The previous low was 1941. and we had the records going back to 1920. So some of the benefits of what's been in the bond market has been the capital appreciation. The problem is that the mathematics of bonds, you get to this level, and it takes very little in the way of a backup in interest rates to start to feed through and create capital losses in bond positions. It only takes about a 15 basis point backup in yields in the 30-year. It takes about 18 or 19 basis points in the 10-year. So the 10-year is going to be about 1.82% right now. If it goes to 2% by the end of the year, it's a loss in that position. Now, not everybody's in 10 years, and people may be in shorter maturities and so on. The further you come, the lower your yield to work with. But the mathematics of bonds right now is such that it's not going to take much of a backup in yields in order to create a problem in the bond market. And we think that problem is simmering. We think that part of it is, it's a combination. Part of it is this function of the Bernanke boom that I would say. That if we're right about this, and that you now have the major economic regions of the world all starting to feed their economies with loose money, that the economies will gain traction, and all it's going to take is one or two surprise economic numbers in the U.S. on the upside, a surprise number on the upside, that the bond market will start to deliver discipline to the Federal Reserve. We likened it to a mirror image of 1994. In 1994, February 4th, the Fed came out and raised rates. It's the first time in 5 years they had raised rates. And if any of you remember, it was when they made the announcement saying, because it's been 5 years since we raised rates, we're going to tell you that we raised rates today. Prior to that, they never told you that they had moved monetary policy. There were Wall Street economists who got paid millions of dollars a year to divine the tea leaves and figure out what the Fed was doing in their meetings each of these six weeks, every 6 weeks or so when they met. The Fed changed that in 1994 and came out and became very transparent and said, we're going to tell you what we're doing. Well, the Fed delivered a very sharp message to the bond market that year. It raised rates 7 times from February until December of that year. And that led to the Mexican peso crisis, which required a U.S. bailout. And then it started to ripple around the world. 2 years later, you had the same thing happen in Asia. And it rippled around. You had the same thing happen in Russia and then Brazil. But it started in 1994, and then the Fed delivered a shock to the bond market. And we think at this time that the bond market is going to deliver a shock to the Fed, because the Fed is now, because of the way it's conducting monetary policy, it's come off of the program of raising and lowering short-term interest rates. It put short-term interest rates to 0 in December of 2008. That was 4 years ago. It hasn't moved them. And now they're telling everybody, we don't think we're going to change monetary policy, which now isn't raising interest rates. Now it's buying all of these securities on a monthly basis. The Fed's saying, we're not going to do that until unemployment gets to 6.5%, as long as inflation is not above 2.5%. That's a recent adoption. So the Fed is so far away from raising interest rates because of this new monetary policy that it has. We think that the bond market is on the cusp of delivering a strong message back to the Fed that it's gone a little bit too far. That we think QE3, we think that E in QE3 stands for excessive. Because financial conditions were not stressed when the Fed eased this time, we think that that's what's going to create the economy to really start to kind of hit on all cylinders, and that you will start to see that back up in interest rates. And you will see the phrase we've seen crop up in the media here recently. It's not going to happen directly, but the phrase the great rotation, moving out of the bond market into the equity market. That $700 billion that moved into bond funds will migrate. It'll move first to cash because they'll suffer some losses in their bonds, which they haven't had happen to them in 4 years. They'll get over that shock, and they'll see the stock market maybe at some of the levels that you already described, and then they'll feel the impetus to go chase stocks, which by then will have already kind of forced out of the gate and gone. So that's sort of the big picture that we see. The last thing that I'll share with you, and then I'll be happy to entertain any questions, is that over the course of the last 4 years, we've been very constructive on the consumer discretionary sector of the economy. We had a strong belief that the U.S. consumer would bring his and her balance sheet back under control, but continue to spend. And consumer discretionary stocks have led the stock market since March 9th, 2009. From that low, it has been led by consumer discretionary. We think that there's a rotation taking place now, or starting to take place, that now that we're past the quote-unquote fiscal cliff, and whatever uncertainty may have accompanied that, yes, there's still the debt ceiling to deal with. They passed today, the House passed today, an extension of 3 months, so maybe it's not going to be so rancorous. But the businesses, we're now going to see the deployment of capital from business. So while the consumers continue to spend this whole time, we now think that you're going to start to see businesses that have built balance sheets of only $1.2 trillion. Now that some of the uncertainty is out of the way, that you're going to have the business sector start to contribute to U.S. economic growth as well. So we see that as a shift, slight change from what we've been doing over the course of the past 4 years. And with that, I'll be happy to answer any questions. Yes, sir.
A question on bond yields. I think of them as credit versus sovereign. So when you talk about 15 basis point change, certainly that devastate the treasury market. But on the credit side, with corporates having large surplus of cash and paying high dividends, I would think the high yield corporate market will continue.
Well, the lower the, so yes, at 1.78% of the U.S. Treasury, all it takes is 15 basis points. The math there isn't as rigorous on a high yield bond. The only thing I'd say about high yields is that the coupon on a high yield bond right now is below 6%. The 10-year yield, the U.S. 10-year Treasury in the 1990s yielded 7%. That was the average for the entire decade. And now you have high yield bonds at below 6%. So it won't be 15 basis points on a high yield bond, but if you do get this eruption in the U.S. Treasury market, the ripple effect will find its way to credit spread product, other sovereigns, high yield bonds, corporate bonds. It will find its way there pretty quickly because everybody's benching off the treasuries. And you have 10 years under 2% right now, and that 2% will be sort of a psychological barrier that'll start to get people's attention. And I already know that 2% is going to create losses for 10s. We bottomed in yields in July. I think some of the similar psychology that's gone on in the gold market is kind of happening in the bond market. And people forget that it's been a while since we've probed new highs in gold. It's been a while since we've probed new highs in bond prices, lows in yields. That was the 31-year bull market in bonds. It started on October 1st, 1981, and it may have stopped in July this past year. It's already backed up 60 basis points. So now, we're yet to be, proven fully correct on that, but the general trend seems to be in that direction. Yes.
The conventional wisdom is short selling is its own art form. You're the only long-short fund in our portfolio. I'm curious if you've got a group of specialized portfolio managers that are in the short staff versus the long.
No.
And with your macro view, if you're primarily shorting countries and economies or specific issuers within a particular country or economy.
Well, the answer to the first question is no. There's not a division between long and short. The same portfolio managers that are making decisions on what to buy are making decisions thematically on what we should be shorting. And those shorts are developed not as quote-unquote hedges. They're not designed to sort of offset long positions. They are cultivated as unique themes by themselves. If it is an emerging market, it is as likely that we would be, sort of broad ETF to participate there. But within a theme, if it lends itself to individual equities, we'll then do the bottom-up research to find where we think the weakest of the group is, or the companies that are most clearly exhibiting the weaknesses that we see, and then select those individual securities to execute.
But you're also saying you could take like an index ETF and use that index itself as a short?
Mm-hmm.
But that's fascinating.
Anybody else? Yes.
All the major countries are basically just printing money on our printing presses, but on other printing presses. And they're doing it to get jobs, that's one, somewhat to help their export ratio. And it seems like it's a game that everybody has to keep printing money. And you talked about Japan. Now Japan, the market went up. But the Japanese yen went from something like 78 to 90.
Right.
And so whatever you gained, you just lost 15% or some number like that. So it's kind of a dicey thing when you look at the world of markets. So it would seem like you have to go to those countries that have the best export ratios and just stay with that. And that would be China would be one certainly.
Well, there are ways to hedge the currency if that is what the driving factor is for the moves in equity prices. There are ways to hedge the currency exposure. As for China, I mean, it's a unique case. It's interesting because it's the poster child for economic growth. 10 to 12%. Slow for them is 7%. And yet the stock market over the last 3 years has gone from 6,000 to 2,000. So there isn't an association between GDP growth and wealth accumulation in equity markets. There's something amiss in the Chinese model, which we think will materialize. It's just right now being cloaked. We're very suspicious of the data that comes out, not just from the government level, but at the company level. Anybody saw Caterpillar yesterday? They had merged with a small company over there, and it turns out that there were shenanigans, accounting misconduct, I think is the way they expressed it, to the tune of $580 million. I think it was 87 cents a share. It's not going to kill Caterpillar, but Caterpillar is not the only one with this kind of a subsidiary over there. The other thing that caught our attention, we had actually a little bit vocal about previously, was we were glad to see it finally happen, was the SEC went after the big four accounting firms here in the United States for their subsidiaries that are doing the accounting work in the companies in China, because they wanted to see the data, they wanted to see the books, and the Chinese are telling them that it's against their own securities laws to provide that information to somebody outside the country. So if they're not that transparent, this is what I was saying earlier about looking at a company, looking at a country, the way you look at a company and you want to see transparency. It doesn't mean the company gives away its trade secrets and all the rest, but the company is transparent in its books. It has auditors come in and look at them. Same thing, you want to see that happening with the country. And when you don't see that happening, it's a cause for consternation. So China's a place where we have a problem with that. Brazil is a place where we have a problem with the interventionist nature of the government. Coming in and unilaterally changing the management at Vale, coming in and unilaterally changing or lowering the electricity tariffs, which is great for consumers, but not so hot for the companies. Coming in and browbeating banks to lower rates on loans to consumers. Fine for consumers, not so great for the banks. So I think the heavy hand of intervention is not a great way to run a country, and it makes us a little bit leery of being involved there. So, anybody else? Yes.
From what you and Alan have said, it sounds like you guys spend a lot of time, put a lot of research into making all your decisions here. When we listen to the nightly news, they make it sound like there's an exact cause and relationship, like some political event that happened in the Middle East, and that's why the stock market's down.
Right.
That's not true, is it?
Well, I'm uniquely positioned to answer that question because in addition to my position, my official position here, I'm also still a consultant to Bloomberg News. I consulted to Bloomberg News for about 6 years, and then I worked for them doing strategic business planning for about 6 years. And I left to do this, and but I still consult over there. So I'm very familiar with what they call, the journalist industry calls feed the beast. They have to put a story out every single day, and that's in print as well as on TV. And reporters, unfortunately, have to get on the phone and get someone to create that cause and effect relationship. They'll call either a trader or an analyst or a small fund manager, or rarely do they get someone of consequence who is willing to boil it down that simply and say, today, stocks fell because of this one event that happened over there. We don't see it that way. But I'm keenly aware of the pressures that journalists are under to come up with that device so that it fits in an 850-word story, and it fits in the first 140 words, and then that gets used by the television anchor, who then reads it off and so on. So, no, it's, if it were easy, people would be up here in diapers doing it, and it's not easy. Anybody else? Okay. Yes.
One last question about, how do you think that the United States' current situation is in terms of manufacturing? Do you think it will become attractive to do more manufacturing here?
Yeah, we were talking a little bit about that in the back of the room before things got started. We do. We think that the U.S. is becoming a more competitive venue for manufacturing. We think that part and parcel of what's going on in Japan, particularly, in China, particularly with them manipulating the currency the way they do, the wage pressures there have gotten quite strained. And I didn't realize it was just maybe a token gesture, but Apple decided to move $100 million a year worth of manufacturing from China back here to the United States. The U.S. currency here has been very quiescent, ever since we've embarked on these rounds of quantitative easing. But yeah, we think that as a destination, the other thing that's going to feed it, I think, is the energy explosion that's going on here in the, no pun intended, taking place here in the United States. The hydraulic fracturing, not just to get gas out, but to get oil out, is really changing the dynamics of energy here. Natural gas is 1/5 the price of natural gas in Asia, for example, here. Now they'd love to ship it. They'd love to put it into a liquefied form, put it on a ship and send it over there. But in the meantime, manufacturers here get the benefit of that price. It's not happening just in gas, it's happening in oil as well. There's a port in Texas, Corpus Christi, that for 6 decades, ships have shown up outside that port, unloaded oil, distributed throughout the United States, went back, got more oil, and came in. In the last 2 months, ships have been showing up at that port and loading up crude oil and being sent somewhere else. So it's as a rudimentary fundamental factor for manufacturing, just the energy situation here is going to have tremendous positive impact for domestic manufacturers.
Brendan, what is the Brent crude oil like quite a bit higher than the U.S.?
Yeah, well, it's stored at Cushing, Oklahoma, and a lot of it is landlocked, it served as a benchmark for a while, but the North Sea Brent grade really took over some years ago, and the differential is probably, I'd have to check, maybe about $18 now. A lot of it is just landlocked. It's just, and part of it is that we're producing the stuff and it's staying here. I mean, it's not being shipped out. So you have a plethora of oil sitting in Cushing, Oklahoma, which is depressing that futures contract, which is what trades in New York, against the Brent crude that trades in London. There are different grades. The West Texas Intermediate, which is what's at Cushing, is a sweet crude oil, and the North Sea Brent is not quite of the same grade. So you're dealing with different grades as well. We're tracking several different crude grades. There's a grade coming out of Canada that's $45 a barrel. We're shocked that there's a product out there. Now, I don't know how sour it is or how difficult it is to distill, but the fact that you had this wide disparity and something as cheap as $45 a barrel coming out of Canada was shocking to us. But we also think that adds to this whole notion of sort of a cheapened energy future here in the U.S. Yes, sir.
I read something just the other day, and I don't know if you have the expertise to comment on this. It kind of surprised me. This article said that the fracking of natural gas is really more expensive than people let on, and that to really justify a new fracking operation would require a price of around $5 or $6 rather than $2 or $3 or whatever it is now.
Well, it's not now. I mean, if that's the case, it's sure being hidden because it's trading at about $3 right now, and that's up from, it may have gotten as low as $2.25 or $2.50. But if that's the case, it's sure being hidden because the stuff is coming onto the market at $3. So, I mean, I guess I'd have to see it to comment further.
He didn't explain it or go into any justification. Threw out a number.
Yeah. Okay. Anyone else? Yes.
I read an article recently here showing that the columnist at the Economist Forbes predicted a 42% drop in the market. He talked about the S&P 500 operating earnings comment about, that kind of a forecast? I mean, I'm not obviously hearing that from.
Yeah, no, well, the S&P 500 companies are going to have corporate profits this year of $1 trillion, and it's 31% more than when the stock market topped on October 9th, 2007. And the stock market is not yet back to where we were, and yet earnings are 31% higher. My understanding is that he manages some family money. My understanding is that he does not manage any public money. It's very easy to be a commentator, but it's very different to, especially in the role of fiduciaries, which is what we do, is to take people's money and then act on those insights, what we hope to be insights. I don't know that he's changed his mind in 12 years. He wrote a book called Deflation about 12 years ago. I don't think that he's changed his tune the entire time. I don't know what his investment portfolio looks like, but I don't think he's managing public money. So it's easy to stand there and say those sorts of things, but until, I mean, it's the difference between shooting at a target and then shooting at a target where people are shooting at you. So he's just shooting at a target. So yes.
While we're in the energy theme, I've read a lot about questioning the value of ethanol. It's a big push to quote ethanol, use corn for ethanol. Isn't really economically justified. Do you have any comment on that?
Well, I mean, I know it's heavily subsidized, and I know that now more than half the corn crop is fuel. So, the subsidy, I guess, is the issue, is the problem with me. I think that it needs to prove itself as a viable product based on its merits and based on the economics of people realizing that they might have to pay $4.25 a gallon to have energy independence if that's something that people value. But it's going to take $4.25 a gallon to do it if you're going to have ethanol-based fuel, rather than having it at $3.85 because you're getting a subsidy from the government. Personally, I think I'd rather see that the free market set it at $4.25. I'm just picking a number. I don't know that that's actually what the number is. But I'd rather see the market forces do that, and then people would know what the cost really is, and decide if that's something that is really important to them to have energy independence, and they do this because we produce so much corn that we can turn it into fuel. So, yes.
Energy independence aside, there's also controversy about the ecological benefits of ethanol, whether it really saves any carbon fossil.
Yeah, and I don't know. I don't know if it's clean, if it's cleaner burning or not. I don't. But I know that in terms of in a big push for energy independence, there's certainly a lot to be said for we can grow this stuff. So. Yes.
Two-part question. Will we ever address all the oil fields that we've identified throughout the United States and Lower Canada and start drilling more? I know the environmental stuff has to do that. The second question is, will gas prices ever go back down?
In the first one, Joey proved this, because all I can do is tell you what I've said for years. What I've said for years is the best thing that when we're at $30 a barrel, I said the best thing that can happen in the United States is to go to $100 a barrel. Because then that kid in that garage is going to find that replacement fuel because it's economical at $100 a barrel with crude oil. So I actually, at $4.25 a gallon or at $100 a barrel of crude oil, I actually think that it's stimulative to that innovative process to find that next generation of fuel that's going to come out. To wit, I think that we will never take all the oil out of the ground. And that the Middle East will choke on a lot of the oil that they have because we will find a replacement. We will find some mix or combination where the technology will change so we're all driving electric cars. If that's what, because they figure out the battery or what, I don't know. But it takes this high price to make that happen. Can you get prices, will prices go back down? Yeah, I think there's a lot of crude oil out there. I think that crude probably I think that West Texas probably belongs around, somewhere around $70 a barrel. And if you got $70 a barrel crude oil, then yeah, you'd have gas prices, below, probably just below $3 a gallon. I don't know how long live that is. I don't think that you go back to $40. $40 used to be the ceiling. We got to $39.15 in October of 1990, just after Iraq invaded Kuwait. We didn't start the war until January 16th of 91. We didn't join the war until then. The market had already peaked. It fully discounted it at $39. When we went to $150 a barrel in 2008, it subsequently broke to $40. And then that was the floor. So that cheap crude oil now is $40 a barrel, which at one point in time was very expensive crude oil. I think probably it belongs at $70 a barrel. And part of it has to do with that Canadian grade. I'm looking at there and saying, this doesn't make sense that you've got competing product at half the price. There might be a little bit of war premium in the crude oil right now. Middle East unsettled, still a premium in the crude oil market. But that's my thought, is it would probably belong at about $70. Okay.
Do we have any general questions on your portfolios or anything like that? Okay, I think there's some really terrific desserts back there. And they've got John Kendall's name on it. Why don't you lead us back there, John? Thank you very much, everybody. Great to have you, and I'm looking forward to a good investment year again.